are. Let's bring in Jefferies chief market strategist, David Zervos. David, more of the same in 2023 in terms of the uncertainty and the skittishness around buying stocks, given some of the questions about the economy and the Fed. Do you think so?
Well, Sarah, I do think it's going to be a little better than 2022 and 2023, but we were down 18.5% total return in the S&P, so not a huge bar to cross there. My expectations on the equity market are that it's really gonna chop around a lot. We've been in this range trade. We've talked about it a number of times over the last quarter or more. I think even going back into Q3. And I think it's going to torture people a little bit. You're going to get these rallies. They're going to peter out. You're going to go test the downside. Everybody's going to get nervous. Then it's going to bounce. For all intents and purposes, I think you're going to have a much more an easier sleep and an easier time focusing in on the credit markets, which have cheapened up dramatically and offer a better risk reward for 2023, especially in the kind of double B, single B region. That's really what we're focusing our clients on at Jefferies.
Isn't that kind of consensus now that stocks are going to have a bumpy road and bonds are going to do better this year?
You know, I don't necessarily think it's consensus. I think there's a lot of people out there that are quite nervous about the fixed income markets. We've had an incredibly difficult year in fixed income. If you compare the years, this was one of the all-time worst years in bonds. This was not. It was a bad year, but it wasn't a catastrophic year at down 18%. So, and we certainly had much bigger drawdowns during inter-year periods. So I'm not sure that it's that consensus. I think people have gotten themselves underweight to fixed income markets, but a huge backup in yields. And, you know, we're very different than we were at the beginning of last year, Sarah. Remember, yields were still very low and spreads were still very tight at the beginning of last year. And, you know, both of them blew out pretty significantly. So I think you have a lot of opportunity there. And the most important thing I would say is, you know, we're in a difficult period of time economically. We're going to probably go and touch recessionary parts. At least some of the economy is going to touch a recession or go into recession, maybe all of it. You don't necessarily want to be in the riskiest part of the capital structure for a business, which is the equity part of the capital structure. Go to the second riskiest part, the credit, the bonds, be a bond holder, collect a double-digit yield in some of this higher yielding, semi-junk bond area, get a very, very large yield compared to what you were getting before, and be in the safer place in the capital structure as we go into a much more difficult time for a lot of corporates in the U.S.